15 popular beliefs or investment themes that can lead people down the wrong path with investing. Don't invest in the stock market. Instead, keep your money safe in the bank. It used to be it was very difficult to get your money out of your brokerage accounts. You would have to call your broker, hope to speak to them, sell your shares, hope that you didn't have an odd lot number of shares, sell the shares, takes a couple days for the trade to settle. Then you'd have to transfer the money or wire the money to a bank account. Takes 5, 10 days, however, for that money to clear at the bank. And then you could withdraw the money. Today, you can sell your shares, electronically transfer the money to your bank account, stick a plastic card in a brick wall, type in a PIN, and it spits out cash. Money is much more liquid these days, and investing, brokerage accounts, investment accounts, even your 401k, by linking these assets to your bank account, you have access to your money a lot quicker than you used to. Always give your stocks a full year before making the decision to sell them. For a stock that's dropping 10, 20% a week, a year can be an eternity. Oftentimes, Wall Street knows a little bit more about the company, about the fundamentals of the company, the nuts and bolts, what's going on behind the scenes of the company. That's what these analysts are good at researching and exploring. And if Wall Street feels that that company is no longer the same as it used to be, you don't want to be on the receiving end when Wall Street is selling that stock. If a stock is going to split, buy it because it's sure to go up. Back in the 90s, when certain stocks were splitting 2 for 1, 3 for 1, 4 for 1, and the shares would continue to rise, it was a great way to make money. You'd have more shares, and the shares would continue to increase in value. But that doesn't always happen, and one doesn't relate to the other. The stock split does not mean the stock's going up, and a stock going up does not mean it's going to split either. There are certain shares out there that have never gone through a share split, and their shares continue to rise as well. There are other companies whose shares have split, and the shares have been stagnant for 5 and 10 years. Be careful buying on that news, that when a stock shares are going to split, it does not mean that that stock is going to continue to rise. Trading stocks is just as risky as gambling. Therefore, trading stocks should not be practiced. Trading stocks is nothing more than selling one company and replacing it for another. So if you had a portfolio of stocks that were falling in value, a statement like that, avoid trading stocks, would mean that you are stuck with those shares indefinitely. Portfolio managers, time and time again, will rebalance their portfolios, trim some of their holdings, and replace those stocks with new stocks, perhaps from new industries that are doing better in today's economy. If you trade your stocks, you are sure to miss the biggest gains and never win. A lot of times people feel that because their stock isn't going up, they haven't given it enough time yet. Tell that to the people that owned Research in Motion. Remember the BlackBerry, the little device, one of the strongest stocks years ago. But eventually that stock, that company, was replaced by newer technology, perhaps a new industry or a new theme that was out there on Wall Street. For those investors that remain steadfast to their stocks, that feel that their particular company is the one, that is how you are sure to miss out on most, if not all, of the future gains that the stock market can present you with. If you hold a stock long enough, you cannot lose. That's probably one of the most dangerous statements out there. If you hold a stock long enough, the company can go out of business. This is America, and these are corporations. And a lot of corporations grind to a halt and eventually shut down. Look at the department stores, look at a lot of technology companies. And other companies, even though they're not out of business, a lot of companies stop trading. If you buy a stock at 50 and it goes down to 15 and the company decides to go private or stop trading, you won't have an opportunity to hold on to your stock and wait for the recovery. Folks, these are stocks. You can lose with stocks, especially if you hold stocks long enough. Stocks of companies that are going in the wrong direction. Low PE stocks make more money than high PE stocks. I can't agree with that. The price earnings ratio of a stock is the price of the share divided by the earnings per share of the company. Price over earnings. If the stock's price is going up and the earnings are going up, the price earnings ratio might go up. If the stock's price is going down, even if the earnings are going up, the PE ratio drops. Be very careful investing solely on PE ratios. Oftentimes, the biggest compliment that a company can have on Wall Street is a high PE ratio. That's Wall Street's faith that the current price is justified based on the earnings and the earnings projection of that company. If a company is making money, buy the stock because it's sure to make money too. Again, it's a partial truth. Folks, when you own stock in a company, you do not own the company. You do not have rights to the profits and the income and the revenue of that company. When you own a stock, you own Wall Street's perception of the future value of that company. And even though the executives might be getting paid and the company might be making money hand over fist, Wall Street may be punishing shares of your company. And if you own those shares, even though everyone's making money, you are losing money. When Wall Street turns against your stock, be careful. If your stock is dropping, buy more shares on the way down because that stock is sure to turn around and go back up. When I look at investing in the stock market, I do have faith that the market will continually reach new highs year after year. History has shown that Wall Street, being one of the most resilient financial markets in the world, has been able to shrug off wars, recessions, depressions, oil prices, inflation, interest rates, you name it. There are times that Wall Street can drop and the stock market takes a while to recover, to fully recover. I cannot say the same about individual stocks. Although Wall Street may be at an all-time high or nearing all-time highs, countless companies, year after year, decade after decade, have shuttered their doors and gone out of business. And if you own those shares, you will not be part of that party that recovers to reach new all-time highs. You know, a lot of folks come to me and say, Brett, let's look at no-load mutual funds because they do better than load funds. When you're looking at a no-load fund versus a load fund, if it is the exact same fund with the exact same holdings and the exact same management team, I would agree that the no-load fund would perform better than the load fund simply due to the internal cost structure. It's very difficult to compare the two solely based on expense ratios and cost of ownership. For instance, if one fund, the no-load fund, was a bond fund and the load fund was a growth fund, over a 5-10 year period, in a good market, that growth fund most likely would outperform the bond fund, even though the bond fund might be a no-load fund. So be careful comparing mutual funds solely based on cost of ownership. Diversifying your portfolio will reduce your losses and it will increase your returns. Diversification doesn't work that way, folks. Diversification tries to prevent you from having all of your eggs in that one basket that falls apart. You spread the risk so you're not overly concentrated in one area that gets hit hard. Diversifying your portfolio can also increase your chances of owning one or two or three investments that are doing well, because we can't necessarily pick the best fund out there by buying a collection of funds or investments. We simply increase our chances of owning one or two funds that are doing well. So it doesn't eliminate losses and it does not produce gains. It spreads the risk. It enables you to invest with a broader brush so that you're not overly concentrated in the wrong areas. You should sell your winners and reinvest that money into your losers. This type of rebalancing can often hinder your performance in that the stocks or the investments, the ETFs, the mutual funds that are doing well, you're selling them and you're putting them into investments that aren't doing well. And if that trend continues, you just sold investments that are going up and put money into investments that are going down. And sometimes these trends can continue for months. They can continue for years. And a lot of times, the reverse is actually a better strategy. Hold your winners. Holding on to your investments that are doing well. These rallies that we've seen can last weeks and months and years. And if you're in those investments for weeks and months and years, that is when you can capture the majority of your gains. All right, so when the overall stock market is falling, never sell anything. I think it's too aggressive of a statement or a strategy to abide by. You could be taking on a lot of risk, especially if the areas that you're invested in are the primary culprits of the stock market correction, drop, crash, whatever it is. We saw back in the financial crisis, the banks, the mortgage companies, those were the investments that were getting hit hardest. Back in the tech stock crash, for quarter after quarter after quarter, it was the technology stocks that were getting pounded. And if you were heavily exposed into those areas, you didn't fare as well as people that may have rebalanced or taken on a more diversified, more conservative approach when they saw that their stocks weren't doing well. So if the stock market is falling, selling everything and going to cash might not be the best strategy and might not be in your best interests, but taking a look at your stocks, assessing where the risk in the stock market is, and perhaps shifting strategies could be a better way to approach that kind of a situation. Again, there are partial truths to a lot of these statements, to a lot of these concepts on Wall Street. But if you believe them to be 100% true, then we both will have wasted our times going through this course. There's more than one way to invest. There's more than one way to take a look at your portfolio, your 401k. That's why, on TV, you'll see 4 analysts. And they all have a different opinion as to what's happening either with that stock or with the stock market. And rarely are any of them right. But by taking a deeper dive into the stock market, understanding what really makes Wall Street tick, what really makes stocks go up and down, that's when you're going to be able to gain a lot better control, not only of your investments, but of your investment making decisions. And that's what we try to teach you here at Seasoned Investors. Good strategies, good theories, good concepts, and we back them with research.